Hello everyone, my name is Shannon, and we're going to spend about the next 20 minutes together talking about home equity conversion mortgages, which are what you usually have heard of as a reverse mortgage. So one of the things before we get started, since I'm not there in person today, most years I am, but I could not be today, I have given you a Notes for Shannon page. I have given you a copy of the PowerPoint presentation. You can text me, you can email me, you can go to my website when we get done. I'm going to have this uploaded to my website so you can go back and watch it again if something wasn't clear and you feel like you need to re-watch this presentation. So please write things down. I would love to hear from you. So what we're going to look at today, first of all, as most of you know, understanding reverse mortgages. That's today's topic. Understanding this part of it is there's two types of reverse mortgage, the FHA government insured product, and then we have conventional or proprietary reverse mortgages. When I meet with people, I talk about their financial puzzle. What are they trying to achieve? So that's always under the understanding a reverse mortgage. How it works, misconceptions, there are a lot, and then reverse fraud. Then we'll move into our proprietary products, which is our HECM for purchase. So you can actually buy a house with a reverse mortgage with the goal, of course, with reverse mortgages, not to have a payment. So I would give you part of the equity, you would bring in part of the equity, and now you would have a home to without a mortgage payment on it. See that in a lot of the different situations, especially when people are moving outside our area to possibly a more expensive market. Then what happens when you leave the home permanently, non-borrowing spouse, ineligible non-borrowing spouses, and market changes, inflation, and how a reverse mortgage can help. As I said in the previous slide, home equity conversion mortgage, or sometimes you'll hear them called a HECM, is our FHA government insured loan. Our lending limit on that one is $1,149,825. And just to get some perspective to this, when I started doing this 20 years ago, the first few years it was very low in the 200,000s, then we went to 360 to 500 for years, and now we have gone to this lending limit, which helps those that are looking to use this product, obviously. The proprietary reverse mortgages would be something that you might equate to a conventional reverse mortgage. There's no mortgage insurance. You can go with higher loan values or more expensive properties. Usually doesn't kick into about $1.5 million to $2 million and can go up to $4 million. So these products are used in those more expensive home markets. Next, when I meet with you, we'll talk about your financial puzzle, because I'm trying to understand how can this help you? Does it help you? Do you even need it? We'll look at the things that you might have in your plan, like 401ks or stocks and bonds. Most honestly, we're usually looking at Social Security or pension income, and that is what you're at when you retire. Sometimes I'll have people that have maybe some rental incomes from real estate, and then they'll also consider the HECM reverse mortgage as part of their retirement plan. I have many CPAs and financial advisors who now are saying to young people, do this, do this, do this, and get your home paid off, so if that you need it in the future, you might be able to do a reverse mortgage. Here's the ones that I always tell people not to count on, and believe it, I'm not making these up. People have said this to me. Sometimes people say, well, I'm just going to work until I die. That is a very good goal. However, we all know sometimes things come up and you're not able to do that. This one, I really did have someone say this. I'm going to be fine. I play the lotto every single week. My kids will take care of me. We have wonderful kids at times, but we don't want to be a burden on our children. And sometimes, you know, the times have been tough. Sometimes they need some help also. And then reverse mortgages are also only meant to be part of your financial puzzle. They were never meant to be your retirement plan. So let's get down into the kind of the 4 bullet points of a reverse mortgage. Number 1, you need to be a minimum of 62. On the proprietary products, you can go down to 55. But again, more expensive property values that are kind of like down the hill. You still pay your property taxes and homeowners insurance. You do not get out of that. The state of California, unfortunately, when we hit a certain age, does not stop having us pay property taxes. You've got to live in your house as your primary residence, and then the balance of the loan, you will not make any more payments, but the balance of the loan will accrue each month, and interest will accrue on that balance that will be due when you permanently leave the property someday. Now, too many misconceptions. I have heard them all. There are products out there, they call themselves reverse mortgages, and they really are not. Where there's a will, there's a way for people to take advantage of other people. But the FHA, government-insured reverse mortgage, came in the 80s under the Reagan administration when he said to FHA, I want a product that will help people 62 and older to access the equity in their property and pull it out to use them in any way that they would like. A stream of payments, a line of credit, cash out, or any combination of those. And then the next thing I'm always saying is, well, what's the catch? Well, the catch is no catch. It's important to remember that the payments are in the form of you cashing out your equity to yourself. So each year you owe more on your house, and you do have to live in the property. So that's no catches. It's just that's how the loan works. Should I get a reverse mortgage? Okay. Those whose heirs need to inherit as much money from them as possible. When I sit down with someone, I say, okay, is there somebody that really needs to inherit a lot of money from you when you're gone, or to inherit your house free and clear? Honestly, folks, times have been tough. Sometimes we have multi-generational families living in a home. If those children need to stay in that home, or the other family member, then maybe you don't want to do a reverse so that they can just pick up and take over payments when you're gone. Parents with disabled children, same thing. Do they need to inherit that house free and clear or with very little debt on it? At those times, we'll look at that very carefully when I'm counseling you and decide if this is really the product for you or not. If you don't intend on staying in your home for at least the next 3 to 5 years, wait and do a reverse mortgage on the home that you're going to. Just remember that there are closing costs with every loan, and you want to use those closing costs on the home that you intend to stay in for the longest amount of time as possible. Those that cannot pay their taxes or homeowners insurance, like I referenced in the last slide, the state of California does not stop asking you to pay property taxes no matter what age you are. If I stop paying my property taxes in about 5 years, they're going to get pretty serious about me paying them. So that is why that is one of the things that you have to make sure. We will pre-qual you to make sure you have the willingness and capacity to continue to pay your property taxes and additionally your homeowner's insurance. All right, I talked about reverse mortgage fraud. There is so many ways to mislead people these days, but one of the biggest ones and the saddest ones that I've run across in the last 20 years is family fraud. When you close a reverse mortgage, when you are done with the process with me, your loan goes into a servicing department, and it is really all about you. Nobody can call on your loan, nobody can access your dollars, nobody can change your reverse mortgage. Nothing can happen as long as it stays with the servicer that has the reverse mortgage. Where I see a lot of problems is when mom and dad or whoever pull out the money and put it in a joint checking account with a family member or even a friend. All of a sudden, you have given them access to all your money because it is in a joint bank account at a local bank. So always be aware of that. That's where I see a lot of fraud. Unethical financial advisors, insurance providers, or CPAs, I do not see that as much anymore because we've built a lot of rules around that in the last 20 years. But if you are going to work with them and they are asking you to take a lump sum of money out to invest or whatever the financial plan is, make sure that is somebody that you know and have had a relationship for years and years and years. Do not get caught up in a seminar somewhere where someone's coming in from out of our area and you don't even know them. So that is lots of great financial advisors. Stick with your locals, stick with the ones that you know. What is a HECM for purchase? Okay, so we talked about that for just a moment. This is basically a loan that allows you to purchase a home with a reverse mortgage. And what I'm going to do is I'm going to walk through some numbers very quickly, and you've got these in your packets so you can kind of study. It's a top to bottom. It should make sense. And remember I was talking about I have people who are starting to want to downsize also and will use this product. And the reason they'll use it is to not have to put all of the money that they get from the house that they sell back into the home and still accomplish not having any house payments. So first of all, this couple in their 80s, they said, we've got to get out of our huge house in Apple Valley and we're going to sell our house. We're going to we're going to downsize a bit, move down the hill, and just downsize a bit. So they sold their old residence to downsize, and they netted $600,000. They're at an age where they're going, well, we'd like some of that money in our pocket in case anything happens and we need it for health issues. So again, the youngest borrower is 80, and look at the red numbers now. They're buying a house for $500,000. The reverse mortgage will give them $102,000 towards the purchase price of that $500,000, which leaves them with needing to bring in $397,745. Okay, right under that, remember they sold their bigger house for $600,000. Now they know they need $397,000 for the new house, and the cash left over once they do the reverse mortgage is $202,255, versus they would have only had $100,000 left over if they had just paid cash for the house. This becomes very important when we start getting into those financial goals and the financial puzzle that we talked about earlier. There's a lot of difference between $100,000 and $200,000. So by not having to use all of their cash to buy the new home, they accomplished getting closer to kids to help take care of them as they age. And number two, they've got a good cushion of cash in their bank account in case something happens and they need assistance. So hopefully that makes sense. If not, write that down on those notes to Shannon, call me, text me, email me, just let me know. I'm going to give you a couple of extra quick examples. And these are examples of parents, my parents actually, when they did a reverse mortgage, they were in their early 60s. They did a reverse, their house back then, because they did it 20 years ago. They paid off a mortgage, got rid of their $800 a month payment, house payment, and they had some money left over that went into the line of credit. That line of credit that they were not using sat there and grew by about $20,000 by the time they needed it when my dad had some health issues. They were able to use those dollars. They had no house payment, so no worries there. They continued to pay their property taxes and homeowners insurance. I'm going to repeat that over and over. And then they were able to pay for some in-home health care because they had done a reverse mortgage. It took all of the stress out of our life having that cushion of money there to use for them. Next, I'm seeing a lot of grandparents helping grandchildren. They have homes that are paid off, they have equity, and they're going, okay, I'm going to help my grandkids with education. We know how expensive that can be. These people, they actually received about $91,000 out of their $450,000 house. They put the money in a line of credit. Line of credit grew at about 7 or 8%, depending where rates are at the time. And they would pull out what was needed when their grandkids had tuition due. So also, there's so many ways you can use it. If they hadn't had grandparents, they could have taken that $91,000 and used it for a monthly payment to themselves, a line of credit, cash out. These are very versatile. I think if I don't make any other point today, ask about a reverse mortgage and ask what it can do for you. The proprietary products, I'm not going to spend a lot of time on this. Like I said, they're more like the conventional arm of the reverse mortgage. There's no government mortgage insurance up front, and they go to the higher limits. So if you are moving into a very expensive area, then this may be the loan that you want to consider. Leaving the home permanently, as I said in my opening slides, the property, you need to look at these loans as just like a loan on your house, even though it's accruing interest and you will owe more money back when you leave the home permanently, you sell it just like any other home. You don't have to call anybody. You get a monthly statement. It'll tell you what your balance is. If you decide to sell, you take it to your favorite realtor and they list your home. They do a net sheet and they just subtract out what you owe versus what you sell it for. If heirs want to keep the property when you leave, when you're gone permanently, then they can pay off whatever your current loan is and they can keep the property. If the balance on the reverse mortgage is more than the market and the value and the heirs still want it, then they can purchase for 95% of whatever market value is. Now, if your house is grown to a huge amount and it's a property that has just increased in value over the years and you owe less than what the house is worth, then you're going to pay off what mom and dad or whoever has used. But if you're in a bad market, the house is upside down, you can buy it 95% of market value. Again, if this piques your interest, write this down on the notes sheet and call me, email me, whatever. If the heirs don't want the property, in my particular instance, I can see my parents' house from my house. If they had passed away, maybe during the recession, if the house was upside down, I do not need their house. I would have called them and called the lender and said, hey, I don't need my parents' house. It's upside down. I'm going to empty it, and then you can take it. But these are non-recourse loans. Even in that situation, if that had happened, they wouldn't have come after me, any of my parents, any other their other assets, me, my kids, my dogs, my whatever. They don't. It's a non-recourse loan. Okay, non-borrowing spouses. This is very good rules that started back in 2014. California is a community property state, so if you are younger than 62, your spouse can take you off of title. However, we will qualify you based on the youngest person or that person that is less than 62. They won't be on title, but if the older person on title does pass away, then that non-borrowing spouse is then put on title. They notify the lender, hey, he or she has passed away, I want to remain in the home, and then that non-borrowing spouse is put into the, gets to keep the property. They do not lose it. That used to be the case prior to 2014, and this was a very bad part of the reverse mortgage that was changed, and maybe not disclosed properly by most people, most loan officers out there. I did, but not everybody did, which was a surprise sometimes when someone did pass away and they thought they had the ability to stay in the house. So very, very important. If you've heard nightmares about someone losing the house because a spouse passed away, they either got to be pre-2014. That does not happen now, okay? If you're an ineligible non-borrowing spouse, sometimes I'll run into people that they're the best of friends. They just can't live in the same house together. He's got his house, she's got his house, but they're still married, and California is still a community property state. If you have that situation go on, then you can be an ineligible non-borrowing spouse if you've never lived in the property. So, yeah, it works for some people. All right, market changes for a reverse. And a reverse is a financial tool. As I mentioned a little bit earlier, I have a lot of financial advisors who are working with younger people now with their financial plan being part of a reverse mortgage. It usually goes something like this, IRAs, does your company have anything, 401ks, what will your Social Security be, will you have a pension, and get your house paid off in case someday you need to do a reverse or want to do a reverse. Also, I see a lot of people who have lost a spouse. You go from one Social Security down, or two Social Securities down to one. Lots of times we will do a reverse mortgage to help that surviving spouse be able to stay in the home. And then what I see a lot with people using it as a financial tool is if maybe you were receiving a stream of income from assets that were maybe in the stock market and we had a change and you're not receiving that monthly amount anymore, then if you have a line of credit, you can turn off that stream of income, wait for the stock market to get better again, but then you could pull it from your reverse and go back and forth. You can turn the reverse off also and just let money sit in the line of credit and grow there also. This probably you're going, what is she talking about? Okay, text me, email me, call me. I love to meet with people and talk about this, and I do in-person appointments. So please let me know, because I'm going through this pretty quickly, and I know it's also a little bit harder when I'm not there. Most years I am. But again, you can go to my website and watch it over and over. Okay, we have made it to the end of our presentation. And again, I'm sorry I couldn't be there with you this year. I will be there next year if I'm invited back, and hopefully I will. Otherwise, we could do this again, but in the meantime, feel free, again, I'm going to say it one more time, email me, call me, text me, and if you'd like to look at this presentation again, you can go to my website, saddlerockreversemortgage.com. Have a great day, and thank you so much for your time and attention today.